If you stand inside a modern AI data center, it really doesn't sound like the future.
Oh, not at all. It's deafening.
Right. It sounds like a jet engine testing facility. I mean, the noise is hovering right around 120 decibels.
Which is physically painful if you don't have ear protection.
Exactly. And the heat generated by those server racks is just so intense that standard air conditioning is like practically useless. You need miles of specialized liquid cooling pipes just to keep the silicon from literally melting down.
Yeah, the physical reality of it is pretty extreme.
It is. And, we always talk about the artificial intelligence boom as this weightless, invisible thing happening up in the cloud. But today, we are bringing the cloud crashing back down to Earth.
I love that.
Welcome to this deep dive, where our mission today is to really understand the very physical, very real-world bottleneck of the AI revolution. Because, while everyone is talking about software algorithms and sleek microchips, we need to look at the concrete, the steel, and the massive amounts of electricity required to run it all.
Right, the stuff you can actually touch.
Exactly. Specifically, we're looking at a company called Applied Digital, and I want to start right out of the gate with a number that genuinely made me do a double take. Applied Digital just reported a 407% year-over-year revenue surge.
Yeah, I mean, that kind of metric usually belongs to like a software startup with 3 employees, not a heavy infrastructure company pouring thousands of tons of concrete.
That is the wild part. And the stock shot up over 20% today alone. It's trading around 27.97 cents right now.
It's been a crazy day for them on the market.
Oh, totally. And if you look at their trailing 12-month revenue growth, it's sitting at over 364%. So let's unpack this right away. How does a company that builds massive physical structures practically quadruple its top-line revenue in that kind of time frame?
Well, to understand that explosive top-line growth, you really have to understand the sheer panic in the tech sector right now. Oh, absolutely. The major tech companies, the hyperscalers as they're called, they are in an absolute arms race to train and deploy larger and larger AI models. And you just cannot run these models on a standard laptop or even like a traditional enterprise data center.
Right, they need way more juice.
Exactly. They require high-performance computing infrastructure. They require unprecedented power density. So Applied Digital is essentially building these highly specialized, incredibly power-dense arenas where this AI training happens. So that 407% surge is really just a direct reflection of insatiable demand. It's the biggest tech companies on the planet suddenly realizing they don't have the physical space to plug their chips in.
Wow. So they are essentially selling water in a desert where every major tech CEO is dying of thirst.
That's a great way to put it.
But, here's where the financial picture gets really complicated, and I want to spend some time looking under the hood of their Q4 2026 earnings report.
Yeah, the numbers are a bit of a roller coaster.
For sure. So on the surface, the headline numbers look fantastic. I mean, Q4 revenue hit $258.74 million.
Which is huge.
Huge. It completely crushed the Wall Street consensus estimate, which was sitting at roughly $95 million. And their adjusted earnings per share was 4 cents, which beat an expected 22-cent loss.
Right. And those non-GAAP numbers, the adjusted metrics that strip out one-time costs, they tell a story of a business that's operating really well on a day-to-day basis.
But then you look at the GAAP profitability.
Right.
And these are the standard, strict accounting principles everyone has to follow, and the picture flips entirely. Under GAAP, they posted a loss of 39 cents per share.
A pretty massive miss.
Yeah, they missed the expected 9-cent loss by a mile, and their trailing 12-month net margin is like negative 42.31%. So let me try to wrap my head around this with an analogy.
Go for it.
Is it like opening a wildly popular new restaurant? Like, you're fully booked every single night, lines out the door, people fighting for tables, but you're still losing money on every single meal because you just took out an exorbitant loan to build the kitchen out of solid gold.
Well, you're halfway there.
Right.
But let's tweak the mechanics of that analogy a bit.
Yeah, what am I missing?
Because they aren't actually losing money on the meals themselves.
Oh, they aren't?
No, the day-to-day operations like the actual server hosting, that's profitable. The issue is how accounting rules treat that golden kitchen of yours.
Ah, I see.
In the world of AI data centers, we call that capital expenditure, or CapEx. Building these facilities requires laying those miles of specialized cooling pipes, installing massive power transformers, securing the land. It is incredibly capital-intensive upfront.
Okay, so they basically spend a fortune before the very first server ever gets turned on.
Exactly. Yes, and under standard GAAP accounting rules, you don't just deduct that massive upfront cost on day one.
Right, you have to spread it out.
you have to account for the depreciation of those physical assets over time, which is usually over 15 to 20 years. So a huge chunk of that 39-cent loss isn't just cash flying out the window from bad daily operations.
It's a paper loss.
Yes. It's an accounting mechanism driven by the massive depreciation costs from building these brand new data centers.
Ah, okay. So the depreciation is just dragging down the official profitability on paper, even if the cash register is ringing at the front door all day.
That is the absolute core of it, yeah. The market is looking past today's gap margins because, honestly, investors aren't valuing Applied Digital based on what they are earning this exact second.
They're looking ahead.
Right. They are pricing in the operational efficiency they expect to see once these data centers are fully built, completely leased out, and humming along for the next decade. They're betting that the massive influx of revenue is going to eventually overwhelm those heavy initial setup costs.
But I mean, if the market is betting on the future, you need some guarantee that the future is actually going to show up and, pay the rent.
Absolutely.
And that brings us to the company's backlog, which is frankly staggering. Management's forward guidance is incredibly aggressive here. They're aiming for a $1 billion annual net operating income run rate, or NOI, within just 1 year.
Which is a bold target. And let's define NOI really quickly because it's so crucial for infrastructure companies.
Yeah, please do.
Net operating income is basically a real estate metric. It's simply the total revenue the property generates minus the day-to-day operating expenses before you even factor in taxes or interest payments on debt.
Right, so it's the core operational cash.
Exactly. So $1 billion in NOI means the core engine of the business is generating a massive amount of pure cash from its properties.
And the foundation for that billion-dollar confidence is their contracted lease value, which just exploded to $36 billion.
It's unbelievable.
It really is. That's up 125% year over year. And these aren't just handshake deals with risky crypto startups, right? These are investment-grade hyperscalers.
Yeah, a $36 billion backlog is a total paradigm shift. I mean, this isn't a software as a service model where a customer can just get annoyed and cancel their subscription next month.
Right, they can't just click unsubscribe.
No, these are multi-year, ironclad take-or-pay leases. And Applied Digital has actually secured design approvals from every major hyperscaler.
Which is huge.
It is not a trivial detail at all. Each tech giant has hyper-specific proprietary requirements for how a server rack needs to be cooled, how it's powered, how it's networked.
So securing approvals from all of them means Applied Digital has become a sort of universal adapter for the whole AI industry.
Essentially, yes. They've standardized the blueprints for everybody.
So they have the blueprints approved, they have the contracts signed, and right now their total contracted AI capacity is roughly 1.4 gigawatts across 5 campuses.
Which is a massive footprint.
Right. And for you listening, 1.4 gigawatts is an absurd amount of electricity. That is roughly the equivalent of a nuclear reactor's entire output.
Yeah, it's hard to even wrap your head around that scale.
It really is, which kind of leads to the most fascinating pivot in this entire story. Applied Digital is actively pursuing natural gas generation to secure electricity for their future campuses.
This is where things get really interesting.
Right. I mean, are data center companies basically having to become power plants now?
Frankly, they don't have a choice. Power availability is no longer just some regulatory hurdle. It is the absolute defining constraint of human infrastructure right now.
Wow.
You can have the fastest NVIDIA chips in the world, you can have $1 trillion market cap, but if you cannot plug the servers into a wall, the AI revolution stops dead.
But why natural gas? I mean, why not just plug into the existing public grid like every other normal business?
Because the traditional electrical grid simply cannot move fast enough. If you go to a public utility today and say, hey, I need half a gigawatt of power, they have to do environmental impact studies, grid load balancing.
Bureaucracy.
Exactly. And then they have to order specialized transformers that currently have like a 3 to 4 year manufacturing backlog. Getting a new power substation approved and built on the public grid can take up to a decade.
A decade?
Yeah. And a hyperscaler cannot wait until 2035 to train their next AI model. They need the capacity yesterday.
Right. The race is on right now.
Exactly. So by pivoting to build their own private natural gas generation, Applied Digital is bypassing that public utility bottleneck entirely.
They are just taking the problem into their own hands. And, it highlights that irony perfectly. You want a smarter, faster virtual chatbot. You have to literally burn natural gas in the real world to power it.
It is deeply ironic.
Mm-hmm.
But strategically, this creates a competitive moat that is just miles wide.
How so?
Well, put yourself in the shoes of a hyperscaler. You need immediate compute capacity. Your options are essentially zero. So if Applied Digital comes to you and says, we have the land, we have your specific cooling design approved, and most importantly, we have our own private power source ready to go.
You just sign the check?
You sign the check. The switching costs are astronomically high. Because where else are you going to go? Nobody else has a spare gigawatt just lying around waiting for you.
So they really have the ultimate leverage here. But building your own power plants and 5 massive data center campuses is incredibly expensive.
Very.
So let's look at the balance sheet, because this is where the math gets a little scary for me. They're sitting on $4.2 billion in cash, cash equivalents, and restricted cash.
Sounds great so far.
It does, but on the other side of the ledger, they have $5 billion in total debt. And their expansion plans are wild. They plan to spend $30 million to $50 million per month over the next 12 to 18 months just on data center construction.
Yeah, every single bit of their free cash flow is being aggressively reinvested into growth. I mean, they aren't returning cash to shareholders through dividends or buybacks right now. They are in pure empire-building mode.
Right.
And to help fund this, they recently secured a new $150 million equity facility, and they've set up these strategic financing partnerships with Macquarie Asset Management and Sumitomo Mitsui Bank.
Okay, let me stop you there and push back on the risk profile a bit.
Sure.
Because there is a logical gap I need to close here. You hear $50 million a month in spending, which sounds terrifying, but they have $4.2 billion in cash. If you just do the math, divide $4.2 billion by $50 million, that gives them like 7 years of runway.
Right, on paper.
Yeah. So why are analysts calling this a massive financial tightrope?
It's a really great question, and it comes down to the mechanics of that specific cash and the scale of the total project. So first, a large portion of that $4.2 billion is restricted cash.
Meaning what exactly?
Meaning it is locked up by lenders in specific covenants. They can't just use it to pay everyday bills or suddenly pivot to a new project.
Ah, okay. The bank is holding it hostage.
Pretty much.
Right.
Second, that $30 to $50 million monthly burn rate. That is just for the immediate near-term phases of construction. Building out 1.4 gigawatts across all 5 campuses will ultimately cost billions more.
Wow. Okay.
And finally, you have to factor in the carrying cost of that $5 billion in debt.
Ah, right. The interest payments.
Exactly. The bank does not care if a supply chain issue delays your cooling pipes by 6 months. The interest payment is still due every month.
Yeah, the meter is always running.
Always. If construction delays hit, or if they face seasonal power cost fluctuations that compress their margins, that interest expense starts eating into their unrestricted cash incredibly fast.
That makes total sense.
So if that $36 billion in contracted leases doesn't turn into physical humming servers generating that $1 billion in NOI on their aggressive timeline, the financing risk becomes acute. Debt is a wonderful tool when you're growing on schedule, but it is a relentless anchor if your operations stall.
The clock is just ticking on the debt while they wait for the concrete to dry.
Exactly.
But, there's a massive speculative catalyst out there right now that could change this math completely. There is a major market rumor, unconfirmed, obviously, but very loud in financial circles, that an unnamed investment-grade hyperscaler is actively helping Applied Digital lower its borrowing costs.
Yes, the infamous mystery tech titan.
Great. The media is just calling them a mystery tech titan.
And if that rumor is true, it is an absolute game changer for their risk profile.
But I'm trying to picture the actual mechanics of this. How does a customer lower your borrowing costs? Are they literally co-signing the loan at the bank, like a parent helping a teenager buy their first car?
Honestly, it's not far off from that.
Really?
Yeah. Think about it from the bank's perspective. If Applied Digital walks into a bank alone and asks for $1 billion to build a massive facility, the bank looks at that negative GAAP profitability, they look at the $5 billion in existing debt, and they calculate a relatively high risk of default.
So they charge a huge interest rate.
Right. But if a company like Microsoft, Amazon, or Google, a company with a pristine investment-grade credit rating and literally hundreds of billions in cash, steps in and essentially backs the project.
Oh, wow.
Yeah, if they guarantee they will pay the lease the very second that building is done, the risk profile for the bank drops dramatically.
So the bank isn't really betting on Applied Digital's balance sheet anymore. They are just betting that the mystery tech titan is good for the money.
Precisely. It's a form of credit rating arbitrage. It lowers the interest rate on the debt, which saves Applied Digital millions in capital costs.
That's brilliant.
It is. But beyond just the math, it provides a massive psychological boost to the market. It signals that the biggest players in tech view Applied Digital not just as some vendor, but as an absolutely essential, too-big-to-fail partner in their long-term AI ambitions.
Wow. So, keeping that mystery Titan rumor in mind, let's look at the stock chart today, trying to see if the market actually believes it, because the price action is a total roller coaster.
Oh, yeah. It's incredibly volatile.
I mean, yes, we had a 20% pop today, but this stock has a hyper beta of 5.84.
And let's translate that for a second just to be clear. Beta is a measure of volatility compared to the broader market, right?
Right.
The market has a baseline beta of 1.
Yes.
So a beta of 5.84 means if the S&P 500 moves up or down 1%, Applied Digital is statistically likely to violently swing nearly 6% in that exact same direction.
That is wild. It is not for the faint of heart.
Definitely not.
And despite today's massive rally, the stock is still sitting roughly 45% below its 52-week high, a 50 point of 725 cents, which it hit back in May of 2026. And the 13-week and 26-week returns have been solidly negative, showing this medium-term downtrend before this recent earnings bounce.
Yeah, it has a real history of these sharp gap-ups following earnings beats, but historically, it has struggled to actually hold those highs, facing pretty heavy technical resistance near that $30 level.
But amidst that 45% drop from the highs, there is a data point that just completely stops you in your tracks.
The insider buying.
Yes. While the retail market has been selling off and driving the price down over the last few months, the insiders, the executives, and directors who actually run the company and see the daily internal metrics, they have been buying.
And buying heavily.
Yeah, in the last 90 days, we've seen net insider purchases of over 1.14 million shares. And, it's not just one wealthy founder making a vanity purchase. It's cluster buying across 4 separate transactions.
That tells a very clear story.
It does. I look at that and think, it's like the captain and the crew of a ship buying more tickets while the passengers are all getting seasick and running for the lifeboats. What do the insiders see in the engine room that the retail market is completely missing?
Well, insiders are simply looking at a totally different time horizon.
Okay, how so?
The retail market, and honestly, even many institutional investors who are pressured to show quarterly gains, they get caught up in those quarter-to-quarter gap losses. They see the $5 billion in debt, they see the negative margins on paper, and they just panic sell.
They get scared off by the surface number.
Exactly. But insiders understand the physical reality of their own business model. They know that the transition from heavy capital expenditure to actual, tangible cash flow generation is a multi-year process. They are buying the dip because they see that $36 billion backlog. They know the actual day-to-day progress on reaching that $1 billion NOI target, and they're betting their own money on their ability to execute.
They aren't worried about the short-term noise.
Not at all. They view that 45% drop from the highs not as a red flag, but as a massive accumulation opportunity.
And it seems like Wall Street analysts are finally starting to align with that insider perspective, right, Ed?
Definitely. Analyst sentiment is largely bullish right now.
Yeah, we're seeing price targets being raised significantly across the board. I mean, Needham reaffirmed a buy rating with an $83 target. Lake Street Capital boosted theirs from $70 all the way to $90. Even Zacks Research, which tends to be highly quantitative and strict, upgraded the stock from a strong sell to a hold.
The consensus forming seems to be that the recent pullback was an absolute gift.
Yeah, and that optimism isn't happening in a vacuum, is it?
No, not at all. You have to step back and look at the massive macro tailwind pushing at Applied Digital's back here. The unprecedented capital expenditure from the hyperscalers is hard to overstate.
It's astronomical.
We are looking at Microsoft planning $80 billion and Meta planning $62.5 billion, specifically for AI infrastructure.
And that money has to land somewhere physical.
Exactly. It doesn't just evaporate into the software ether. It goes into the land, the power procurement, and the liquid cooling systems that Applied Digital is currently out there building.
It has to touch the ground eventually.
Right. When you have macro tailwinds of that sheer magnitude, we're talking hundreds of billions of dollars looking for a physical home. The rising tide lifts the companies that already have the shovels in the ground.
Which gives us some very clear, tangible catalysts to watch on the horizon. First, obviously, we have Q1 2027 earnings coming up in late October.
Right. Everyone will be watching for progress on that $1 billion NOI run rate just to make sure the math is tracking as promised.
Exactly. But physically, the critical event is the ramp-up of their 400-megawatt Ellendale campus.
Well, that's the big one.
Yeah, getting those signed lists translated into actual humming servers in that specific facility is what will really drive the near-term gross margins. It's what will prove that this highly leveraged model actually works in practice.
Execution is everything from this point forward. The demand from the hyperscalers is obviously there.
Yeah.
The capital from the banking partners is there. Now it's just about pouring the concrete, securing the natural gas, and flipping the switch without any delays.
Okay, we have covered a massive amount of ground today. Let's briefly summarize the mission we set out on.
Do it.
Applied Digital is the ultimate hyper-growth story sitting at the exact intersection of the AI software boom and the heavy physical infrastructure required to make it a reality. We've seen a jaw-dropping 407% revenue surge. They are sitting on an ironclad $36 billion contracted backlog, and there is deep conviction-level insider buying across the board.
But of course, that immense potential is balanced against the very real gravity of their current situation.
Right.
High debt levels, short-term gap losses driven by massive depreciation, and a cash burn rate that requires absolute precision in their construction and leasing execution to avoid a liquidity crunch.
Yeah, the financial tightrope is very real. And for you listening, whether you are actively investing in the AI sector or, you're just someone who uses AI tools in your daily workflow, understanding this dynamic completely changes how you view the technology.
It really pulls back the curtain.
It does. The cloud isn't invisible. It has a massive physical footprint. It requires concrete, copper, natural gas, and billions of dollars in capital just to keep the models thinking.
The physical infrastructure is the ultimate reality check on the AI hype.
Yeah.
You just can't outcode
You
physics.
can't outcode physics.
I
Love that. And that leaves us with one final thought I want you to mull over after this deep dive ends. We talked at length about Applied Digital being forced to bypass the public grid and build their own private natural gas plants just to guarantee they have enough electricity for their data centers. If AI requires so much raw power that private tech infrastructure companies are now entering the power generation business just to keep the servers running, what does this mean for the future of the global energy grid?
It's a huge question.
Are we looking at a future where tech giants essentially control their own private power supplies, completely divorced from public utilities? And over the next decade, as the public grid strains under the weight of AI's insatiable demand, who ultimately ends up paying for that power?
Yeah, something we all need to be thinking about.
Definitely. Thanks for joining us on this deep dive. We'll catch you on the next one.